Hello everyone, you are watching Saheb Academy. If you like our videos, then please subscribe to our channel and also hit the bell icon for the regular updates, and also follow us on Instagram, Saheb Academy. Now let's go to the video.
Hi everyone, this is the fourth video of Amalgamation chapter. Now in the previous videos we have seen the concept and we have solved 3 problems on purchase consideration, and we have seen the accounting treatment in the books of Transferee Company, right? Now here in this video, what are we going to do? In this video we are going to see the accounting treatment in the books of Transferee Company. Now if you're watching this video as your first, then you will be wondering, what is this transferee company? What are you talking about here? See here, let's take a small example to understand that properly. See here, let's say there are 2 companies, okay, Beta Company and Alpha Company, and let's say this Alpha Company purchases the Beta Company. It acquires the Beta Company, right? So now what will happen is this Beta Company will lose its existence to become part of Alpha Company. Okay, because Alpha Company has absorbed the Beta Company, yes. So this company will lose its existence and it will get liquidated, it will get dissolved. So now this Beta Company will be called as Old Company or Transferer Company or Vendee Company. Yeah, there are lots of names to it, or Selling Company also, because it has been sold to Alpha Company. And this Alpha Company will be called as, because it will be continuing on, so now this company will be called as New Company, Transferee Company, or Purchasing Company, or Vendee Company. Okay, there are lots of names to it, but here in this video series we are going to use these 2 terms. Okay, transferer for the old company, transferee for the new company. And see, these 2 terms are almost similar, right? Transferer, transferee. See here, it's very easy to not get confused with these 2 terms. See here, old company, O, right? So O, old company, transferer, old company, and then transferee, E, new company. Understood? That's how you have to be very clear with these 2 terms and never get confused between old company and new company, right? So now here Beta Company is the old company and Alpha Company is the new company, which is called as Transferee Company. So now here we are understanding the accounting treatment in the books of Alpha Company, the Transferee Company. So for that we have got an accounting standard 14 which applies on only Alpha Company. Okay, this AS 14 gives us the guidance on how to treat the books of Alpha Company. Okay, yes, and this AS 14 doesn't apply on the Beta Company, okay, because we have seen the accounting treatment, the journal entries and the ledger accounts we have to pass in the 3rd video, where we use realization account, yeah, and we close the books of Beta Company because this company is going to be liquidated. But the Alpha Company is not going to be liquidated. It will continue on, it will carry on its business. So for that, AS 14 applies on Alpha Company only. Understood? So now what do we have in AS 14? See here, in AS 14 we have got 2 methods. Okay, the first method is pooling of interest method and the second method is purchase method. So now when to use this method and when to use this method? See here, it's very simple. When the amalgamation is in the nature of merger, you have to use merger method, or it is also known as pooling of interest method. And when the amalgamation is in the nature of purchase, then you have to use purchase method. Understood? So now just by looking at the question in exam, you have to understand whether it is amalgamation in the nature of merger or amalgamation in the nature of purchase. So how are you going to do that? That's the big question, right? How to identify just by looking at the question which amalgamation it is, yeah, whether it is amalgamation in the nature of merger or amalgamation in the nature of purchase. Accordingly only we have to use these 2 methods. Yes, so for that we have got 5 conditions that we have to look for. See here, if these 5 conditions are satisfied, yeah, these 5 conditions are satisfied, then it is called amalgamation in the nature of merger. And if these 5 conditions are breached, are violated, yeah, if any of these 5 condition breaks any of the 5, then it is called as amalgamation in the nature of purchase, if any of those 5 conditions are violated. Simple. So now let's go through these 5 conditions. See here, it's very simple. Now the first condition is, see here, all assets and liabilities are acquired. All the assets and liabilities of Beta Company, of Transferer Company, old company, should be taken over by the Alpha Company, by the new company. Whatever assets and liabilities the Beta Company has in its balance sheet, everything should be taken over by the Alpha Company. That's the first condition. Yeah, if in the question they say some asset or some liability, any asset or any liability, okay, it's not taken over, then immediately you should understand it is amalgamation in the nature of purchase, because the first condition has been breached, it has been violated. Okay, that's the first condition. Everything should be taken over, all assets, all liabilities. And then the second condition is everything should be taken over at the book value. Book value means the value at which the assets and liabilities are there in the beta company's balance sheet. Yeah, whatever value is there in the balance sheet, at those values only alpha company has to take over all the assets. If the alpha company modifies, revalues any of the asset, yeah, if it changes the value, if it takes over the assets or liabilities at the fair value, at the market value, or at the agreed value, then you should immediately know it is amalgamation in the nature of purchase, because the second condition has been violated. Simple, right? All assets and liabilities should be acquired, and all assets and liabilities should be acquired only at the book value. Right. And then the third condition is same business should be carried on. What does it mean? See here, it's very simple. If this beta company is in telecom industry and alpha company is taking over the beta company, then alpha company should have the intention that it will continue the business of beta company in the same industry. It is taking over the beta company. Whatever assets and liabilities, whatever is there, it will become the assets and liabilities of alpha company, and it has to make sure the business will carry on in the same industry. It will not change the business of beta company. Yeah, the business should be carried on, the same business. That is the third condition. Understood? And then the fourth condition is, see here, shareholders of beta company. Shareholders of beta company who have at least 90% of equity share capital. Shareholders of beta company holding at least 90% of equity share capital should become equity shareholder, ESH, equity shareholders of new company. That means shareholders who have 90% of equity share capital of beta company should become equity shareholders of alpha company. जो भी shareholders हैं जिनके पास 90% शेयर कैपिटल है of beta company, वो लोग shareholders बन जाना चाहिए of alpha company. Simple as that. Okay. And then the fifth condition is, see here, PC, purchase consideration. Purchase consideration means something that is paid to the owners of the old company by the transferee company. या ये company कुछ देती है to the owners. Who are the owners? Preference shareholders and equity shareholders. So what do they give? They give in form of shares, debentures. They give in form of bonds. They give in form of cash. So now purchase consideration can be in form of various things, various forms. So here the condition is that this purchase consideration should only be in the form of shares. Only be in form of shares. Equity shares to equity shareholder, preference shares to preference shareholders. Okay, that is the condition. Purchase consideration should be paid only in equity shares and preference shares of transferee company. मतलब alpha company जो देगी to beta company's owners, preference shareholders and equity shareholders, it has to be in form of shares, equity shares and preference shares. Simple as that. Okay, if they say in the question debentures are given, bonds are given, or cash is given, then immediately you should come to know that condition has been violated. It is amalgamation in the nature of purchase. Simple conditions are there. The first condition, all assets and liabilities should be taken over at book value only. Same business should be carried on. Or shareholders, the shareholders who have 90%, at least 90% of equity share capital should become equity shareholders of transferee company, and purchase consideration should be paid only in equity shares to equity shareholders and preference shares to preference shareholders. So these are the 5 conditions that have to be satisfied. If any of these 5 condition breaks, okay, then you have to understand it is amalgamation in the nature of purchase and you have to use purchase method, or else all these 5 conditions satisfies all these 5 conditions, then it is merger method. Okay, or sometime in your BCom BBA exam what can happen is they will mention itself clearly, solve it by the merger method or solve it by the purchase method. Okay, it depends upon the question. So now we are going to see the journal entries that we have to pass in both the methods. Okay, it's very simple, little bit difference is there. Okay, don't worry, it's very simple. So now let's jump to the journal entries. Okay, and let's see what are the journal entries that we have to pass in the books of alpha company. Let's go to the journal entries. Now here we have the journal entries in the books of Transferee Company or the Vendee Company or Purchasing Company. So now here, according to the Accounting Standard 14, we have got two methods, purchase method and merger method. Yes, so the journal entries according to the purchase method is different and the journal entries according to the merger method is different. So first we are going to focus on the purchase method only, and then in comparison we will see the merger method. Fine. So now let's start. Now here we have the first entry that we have to pass. See, here is very simple. The first entry is purchase consideration due entry. We have to make the PC due, right? See here in 11th standard, what used to be the entry for simple credit purchase from Sham? Let's say we purchase goods from Sham. So what used to be the entry? Purchase account debit, yeah, purchases account debit to Sham, isn't it? Simple credit purchase entry. Now here, are we purchasing goods? No, we are purchasing a whole company, right? So now here we are purchasing a whole business, so we have to use the term business purchase. So this temporary account we will open, business purchase account debit, right? And then to liquidator of transferor company. Why liquidator of transferor company? What is this? See here what is happening, we are purchasing the business and we are accepting that we have to pay to liquidator. Now you are saying, who is this liquidator person? See, now we are purchasing this company, old company, which is going to be liquidated. Now who will do this liquidation process? Liquidator, a person will be appointed, okay, who will be in charge of this whole liquidation process, and he will handle all the receipts and payments that he has to do to liquidate that company. Yeah, you have seen that in the liquidation chapter. Yes, so now here we are purchasing, by we I mean Transferee Company. We have to think from the point of view of Transferee Company, because we are passing the journal entries and doing the accounting treatment in the books of Transferee Company, the new company. So you have to think as an accountant of Transferee Company. So now we, Transferee Company, we have to pay purchase consideration to Transferor Company. Yes, so now to whom are we going to pay that? Yes, owners of the company. But actually that purchase consideration will be handed over first to the liquidators, to the liquidator, okay, liquidator of transferor company. Yes, and then he will see how it is discharged, how it is given to the owners of the company. Okay, so first we will hand it over to the liquidator. But now in this entry we are not making the payment. Here we are just making the PC due. We have to pay purchase consideration to the liquidator of transferor company. So for that, entry is very simple, business purchase account debit, okay, to liquidator of transferor company. We as a transferee company have to pay to liquidator, so our liability is increasing, and you know, if liability increases, you have to credit this personal account to liquidator of transferor company. Simple as that. And what amount you will take it over here? Purchase consideration. Yeah, what calculation you will do of PC, that you have to take it over here. Okay, simple, business purchase account debit to liquidator of transferor company. And it is same with the merger method also. Okay, we'll come to that later, but there is no change in these entries. Okay, same entry, fine. Then the second entry is simple. See here, the second entry is for taking over assets and liabilities. What all assets, what all liabilities you have taken over, by you I mean transferee company, we have taken over from this company, have to be shown in this entry. Okay, what all assets and liabilities. So here you have to understand net assets. Do you know what net assets is? If you don't know, see here, it's simple. Asset minus liabilities is the net assets, and that is what we take over from the transferor company. Yes, what we do is we take assets. Let's say assets were 10 lakh. So we took over assets of 10 lakh, and then we take over the liabilities also. Yes, let's say the liabilities were 4 lakh. So in total, what have we taken over? What have we taken over of transferor company? Assets of 10 lakh, liabilities of 4 lakh. So net assets is 6 lakh. That is what net asset is. Okay, asset minus liabilities. So then what you will do is, see here, you will take assets account debit. Okay, this is the entry. See here, let's come to that net assets. See here the entry, assets account debit. One by one you are going to take all the assets at the agreed value, whatever that is agreed between you people, transferor and transferee. Yes, it will be given to you in the question. If nothing is given, then you have to take the book value as the agreed value. Fine. So assets account debit two liabilities account, one by one take all the liabilities, debentures, whatever you have taken over, creditors, trade payables, whatever is there, take, okay, whatever you have taken over, yes, and then you have to take this two business purchase account also. But why are we taking two business purchase account? Yes, we have understood why we are taking assets and liabilities. You just told us that we have to what? We have to do the segregation. Yes, we have to show what we have taken over, assets and liabilities. One by one we have to show that. But why business purchase? See here, this account business purchase needs to be closed. Here it was debited. We have to credit that to close that account with the same amount, PC. Okay, because we are showing the segregation of this PC, of this business purchase, what we have purchased in from this business, by showing the assets and liabilities. Okay, so we have to close business purchase account. So debit is equal to credit. We will cancel off the business purchase, this temporary account. Fine. So now here what is happening? Assets are getting debited and liabilities are getting credited. So actually we are taking over the net assets, assets minus liabilities. 10 lakh of assets, liabilities of 4 lakh. So then we have taken over 6 lakh of net assets. And what have we paid them? What have we paid to transferor company? The PC, purchase consideration. And let's say the purchase consideration is, let's say it is 5 lakh. How much? It is 5 lakh. So now what will happen? See here it is 10, here it is 4, yes, and then here it is how much did I say? 5 lakh, yes. So now net assets you have taken over of 6 lakh and you have paid only 5 lakh. So that means you have paid 1 lakh less. You have paid 1 lakh less because the purchase consideration is 5 lakh and you have taken net assets of 6 lakh, then you have made a gain of 1 lakh. Yes, there will be a balance on the credit side. And if there is a balance on the credit side, then it will go to capital reserve. It will go to capital reserve because that gain is not some normal gain. No, it happens very rarely, right? It's a non-recurring thing. So that has to go to capital reserve, that gain on business purchase. Okay, you have made a profit, right? You have paid only 5 and you have got net assets of 6 lakh. Understood? And if let's say you had paid 8 lakh of purchase consideration and you had taken over 6 lakh of net assets, right? If you have paid more, then the balance would have come on the debit side. That means you have made a loss. You have got 6 lakh net assets, you have paid 8 lakh business purchase, 8 lakh of PC, then you have made a loss, and that loss will go to goodwill account. We have to capitalize that loss. Okay, we have paid more. Why do we pay more for anything? Because of its quality, isn't it? So that is what here we are purchasing a business, not any simple product. No. So why are we paying more to this transferor company than its net assets? If it has net assets of 10 lakh and let's say we are paying 20 lakh, 10 lakh extra, so that means there is something about that business. Yeah, it is that goodwill of the business due to which we are paying more, and that goodwill of that business will cause us to earn more in future. Okay, we will have greater and good profits in future, so that is why we are paying him more. Okay, that is the goodwill. So that is why we pay more, and that paying more is a loss, and we have to capitalize that loss, and it will be written off in the period of 5 years. Okay, so you don't have to worry about that. Just simple thing is, if the balance comes on debit side, goodwill, credit side, capital reserve. Understood? These are the two balancing figure. If it's on debit, goodwill. If it's on the credit, capital reserve. Capital reserve is gain and goodwill is a loss. Understood? This is the second entry. And then the third entry is, see here, adjustment of loss or profit on merger. Now this is of the merger method. It is not on the purchase method. So there is no entry for that. Okay. So we'll come to that later. Then the fourth entry is, see here, it's very simple. The fourth entry for payment of purchase consideration. See, for payment of purchase consideration. Now here in the first entry you accepted that you have to pay to liquidator, but now you have to pay to them, right? Here you made due, you have to pay. Liability was increased over here, but now here you have to make the payment. Here you have to make the payment for payment of purchase consideration. So now that liability will get decreased, isn't it? If you pay something, then the liability is no more, it is decreased. So you have to debit that. You have to cancel that account. liquidator was credited because liability was increasing. Now you have to reduce that liability by debiting liquidator of transferor company account. Simple. And then what have you paid to the transferor company? Purchase consideration can be in many forms, right? So in what forms you have made the payment, you have to take all that to equity share capital. And if you have issued the shares at at more than face value, and that would be the case in most of the problems, then you have to take the premium, the money that is over the face value, to the securities premium, right? You know that. So you have to segregate that. Okay, don't take entire share capital into equity share capital only. No, see properly that only face value goes to equity share capital and the extra thing will go to securities premium. And then the purchase consideration can also be in form of preference share capital, yeah, and then debentures, cash. Yes, so this is what the entry of payment of purchase consideration. What all things you have paid to whom? To liquidator of transfer company. Yeah, liability is getting reduced, debit that account, and what all payments you are making, what all things are going out. Yeah, that's it. Simple. Fourth entry is simple. And then fifth entry we have got recording statutory reserves of transferor company. Now see here, what will happen is, see here, statutory reserves. See here, it's very simple. First you have to understand what are statutory reserves. Statutory reserves are the reserves that are created by the company because the law or the statute or the act tells the company to create a certain reserve for a certain number of years and show it on the face of your balance sheet under reserves and surplus. And that is what all the companies do. If law tells them something, then they comply with the law. Yes. So the same thing, let's say you also did in your company. You had a company and let's say the law told you to create a certain reserve for 5 years. Let's say it was investment allowance reserve. Yeah, there are many statutory reserves. I have written 3 over here. See here, investment allowance reserve, export profit reserve, rebate reserve, and many more are there. You can see that in your book. Fine. So now let's say the law told you to create this IAR, investment allowance reserve, for 5 years. Yeah, and you did that. You complied with the law. Whatever the law told you, you did that. On the face of the balance sheet, you created a reserve called as IAR, investment allowance reserve, and let's say 2 years have been passed. Yes, and the expiry period is 5 years, right? So now 2 years have been passed, still 3 years are there to go. But then what happened? Then let's say your company was acquired by another company. Yes, so automatically now what will happen? The company which acquired your company will become transferee, and your company will become transferor company, and your books will be closed. Yes, your whole balance sheet will be killed. Yes, it will be closed down. Your company will get liquidated and these reserves will lose its existence. Yeah, but then what does the accounting standard 14 says? It says that you cannot kill statutory reserves. These statutory reserves have to be continued, and the law also tells that. Yeah, so now what will happen is these reserves which were there, statutory reserves, have to be created in the new company also. It will become the responsibility of the new company to carry on those reserves. Those reserves, those statutory reserves which were there on the face of the balance sheet of the old company, it has to be exactly mirrored. It has to be exactly created on the new company's balance sheet also. So transferee company have to create them and show on its balance sheet those statutory reserves. It is mandatory. Okay, so that is what happens. Yeah, these statutory reserves have to be mirrored exactly. They have to be duplicated exactly on the new company's balance sheet. So basically what I'm trying to tell you is, in the transferee company, now as we are doing transferee company's books, right? So we have to create reserves, statutory reserves in the new company's balance sheet if they were there in the old company's balance sheet. Yeah, so how to create reserves? What balance in accounting? How do you create reserves? What balance does reserves have? They have credit balance. So if you want to create reserves in the balance sheet of transferee company, then what journal entry do you have to pass? You have to credit the reserves. Are you clear about that? If you want to create the reserve, since reserves have credit balance, so increase the reserve. To increase the reserves, you have to credit them. So that is what exactly you are going to do. See here, recording statutory reserves of transferor company. See, you are going to credit the reserve, whatever reserve you want to create. Investment allowance reserve to investment allowance reserve. If it is export profit reserve, to export profit reserve. It will be given to you in the question, okay, what reserves are there, and if there are any statutory reserves, then you have to pass this entry to record it in the books of transferee company also. So it is clear to you, right? You have to credit the reserve to create the reserve, but then an entry cannot be a handicap entry. There has to be some debit, right? So the debit would be amalgamation adjustment account debit to statutory reserves. Now don't go on finding the reason why we are debiting amalgamation adjustment account. Is it an asset? Is it a liability? What is it? No, nothing. There is no logic behind this debit. Okay, amalgamation adjustment account. It's just a fake entry. I mean, the fake, fake name is that. That's all. Amalgamation adjustment account. There is no logic behind this term. Okay, amalgamation adjustment. It's just that we have to create the reserve, but we cannot have a handicap entry, right? We are doing double entry over here, so there has to be some equal debit. So we take it as amalgamation adjustment account debit to statutory reserves. Is that clear? Is that clear? Don't go on finding the reason behind the debit. Okay, it's just that we cannot have just single credit entry, right? We have to have an equal debit also. So that is why, and we are doing this because of amalgamation. So that is why we are using this term amalgamation adjustment account debit to statutory reserves. Is that clear? So this is the fifth entry that you have to pass if there are any statutory reserves. Okay, now in the most BCom exam, what will happen is you will not get this entry. Yeah, it might come, but there is a very less chance. Okay, and then the sixth entry is, see here, issue of debentures to debenture holders of transferee company. So now what will happen is, see here, when the transferee company takes over the liabilities of transferee company, then if there are any debentures of transferee company, then those debentures will also be taken over by the transferee company. Yes, but then transferee company was supposed to pay cash to those debenture holders and settle the liability. Yes, but sometime what can happen, transferee company will not pay cash. Transferee company will give its own debentures instead of cash to the debenture holders of transferee company. Yes, it will issue its new debentures and the old debentures will be cancelled. Okay, पुराने debentures cancel करो और हमारे debentures आप ले लो. Alright, so now here what will happen, one debenture, old debentures will be cancelled and new debentures will be issued. Understood? So issue of debentures to debenture holders of transferee company. See here, let's say the old debentures were 9%. So 9% debenture of transferee company account debit. We will debit that old debentures, and let's say the old debentures were 9%. So 9% debenture of transferee company account debit. To cancel the liability, we will debit that. Yes, and then we will create the new liability, the new debentures. We will issue the new debentures. So let's say it is 11% debentures. So 11% debentures of transferee company account credit. Why credit? Because we are creating the liability. So to create the liability, you have to credit. And then if the value of new debentures is more, then that would be called premium, and premium will go to premium on debentures. And if the new debentures value is at discount, then if it is less, then discount on issue of debentures. Okay, that would be the entry, simple entry. Cancel the old debenture, debit, create the new debenture, credit, and then if there is a premium, that will be credited, and if there is a discount, that will be debited. Simple entry. Yes. And then the seventh entry is, see here, payment of liquidation or realization expenses by transferee company. If the expenses of transferee company, liquidation or realization, if those expenses are paid by transferee, then we have to make an entry in the books of transferee because this company is paying, right? If the expenses are paid by transferor only, अगर ये company खुद अपना expense खुद pay कर रही है, then no entry in the transferee company. Okay, remember that. Only if payment is done by transferee, then only you have to pass an entry. Right, so the entry would be, see here, goodwill account debit, capital reserve account debit to cash account. Now you will be wondering, why are you not taking realization expenses or liquidation expenses or whatever the expenses, that account? Why are you taking goodwill account or capital reserve account debit to cash? See here, that is because this expense is paid by transferee company, and this is not just any normal expense. No, it is expense related to transferor company. Yes, so we consider this expense as a cost of acquiring that company only. So we capitalize this expense. हम ये expense को balance sheet में लेके जाते हैं. Okay, we capitalize this expense. And why goodwill or why capital reserve, and when to take goodwill, when to take capital reserve? See here, it's very simple. You have to see the second entry. If in the second entry you have got balancing figure as goodwill, then you have to take goodwill. If in the second entry you have got balancing figure as capital reserve, then you have to take capital reserve. But why? See here, it's very simple. Let's focus on the second entry first, then only you will be able to understand. See here, let's say the purchase consideration, business purchase, was for 5 lakh. We gave PC of 5 lakh and we got net assets of 6 lakh. Then you will be very happy that we have made 1 lakh profit, and that profit, that gain on that business purchase will go to capital reserve. You know that. Yes, capital reserve. And you are thinking you have got 1 lakh of profit by paying only 5 lakh and getting net assets of 6 lakh. But actually what can happen later, you can come to know that you have to pay 50,000 worth of expenses. 50,000 worth of expenses. You have to pay. You transferee company has to pay expenses of transferor company. तो क्या होगा? Then your profit is not 1 lakh. Is it 1 lakh your profit? No, because to acquire that business you also had paid their expenses also. So वो भी खर्चा है ना, that is also an expense. 50,000. So 1 lakh profit कहाँ हुआ? Only 50,000 profit हुआ है. Isn't it? You thought you have made a 1 lakh profit here, but later you came to know that you also have to pay expense of 50,000 and you are capitalizing that expense, you are taking it to the balance sheet. So then क्या होगा? You have to reduce your profit. You have to reduce your profit, and to reduce the profit, to reduce the capital reserve, what do? Capital reserve, reserves always have credit balance. To reduce the profit, to reduce the reserve, you are going to debit that capital reserve account debit. This is the logic. पहले तुम बहुत खुश हुए थे कि तुम्हें 1 लाख प्रॉफिट हो रहा है, उसके बाद तुम्हें मालूम पड़ा दैट 50,000 एक्सपेंस भी पे करना है, सो मेरा प्रॉफिट तो सिर्फ 50,000 हुआ है, राइट? बिकॉज हम ये पेमेंट भी कर रहे हैं ना. So you have to reduce the profit, and reduce the profit means you have to debit. Simple. Yes. Then what about goodwill? Why goodwill and when to take goodwill? Now वो मैंने तुमको पहले बता दिया कि goodwill इधर आएगा तो नीचे भी goodwill आएगा, right? See here, the logic is, let's say you purchase the business, you gave the PC to the transferor company 8 lakh. How much? 8 lakh. And let's say the net assets, asset minus liabilities, were only 6 lakh. So then 2 lakh extra क्यों पे किया? Because of goodwill. 2 lakh extra, that is your loss. Yes, that is your loss, and loss goes to goodwill and it is capitalized in the balance sheet and amortized. It is written off in the period of 5 years. That's fine. Now goodwill 2 lakh का loss हुआ है. You are thinking only 2 lakh का loss हुआ है. Yes, you have incurred only 2 lakh loss, but then later you came to know that you have to pay 50,000 of expenses also. अरे यार मेरे को तो और 50,000 expense भी pay करना है. So that is also my loss now, isn't it? That is also cost of acquisition. Understood? पहले तुम्हें लगा सिर्फ 2 लाख लॉस हो रहा है, but later you came to know you have to pay 50,000 expenses also here. So again 50,000 loss. So in total 2,50,000 loss. Here 2 lakh and here 50,000. So that is why you have to capitalize this loss also to goodwill account. You have to increase the goodwill account. So you have to debit the goodwill, and goodwill is an asset. It is an asset. So to increase the asset, what you will do? You will debit. So goodwill account will be debited. Either goodwill or capital reserve will come. Simple as that. Goodwill account or capital reserve account debit to cash. Simple as that. Okay, fine. And then the 8th entry is, see here, payment of preliminary expenses. Now these are the expenses that are incurred to incorporate company, okay, to form the company. And these expenses are always capitalized. Okay, preliminary expenses account debit to cash account. Fine. So this is the entry for that. Simple. You are incurring this expense and you are paying cash. Cash is going out. Simple. Preliminary expenses account debit to cash account. Simple as that. So this is the last entry that you have to pass. So these are the entries under the purchase method. Don't worry, it's simple. It's not tough. Okay. Now let's see the merger method in comparison to this, and what are the differences between the merger method and the purchase method. Right. Let's go to the merger method. Now let's see the merger method. What journal entries do we have to pass under the merger method in comparison to purchase method? See, in the first entry of making purchase consideration due, you have to pass the same exact entry as the purchase method. There is no difference at all. Business purchase account debit, you are purchasing the business. Business purchase account debit to liquidator of transferor company. You have to pay to liquidator. Your liability is increasing, you will credit that account and you will take PC amount. Fine. In the second entry for taking over assets and liabilities, there is a difference. See here. The entry is all assets account debit, to all liabilities account, to all reserves. Yes, you're also taking over the reserves also over here. We'll come to that. To business purchase as usual, to business purchase. And then the balancing figure, if it comes from the debit side, you will take it as loss on merger because you are paying more than what you are getting, what net assets you are getting. and if you are paying less, you are paying less than what you are getting, what net assets you are getting, then the balancing figure would come on the credit side, and that would be profit on merger. Fine. So now why is it different? Why this entry is different? Because of the condition of merger. See here, in merger, what is there? There are 5 conditions, right? All assets and liabilities should be acquired. So that is why everything should be acquired. सब कुछ लेना है नई company को, right? The new company has to take everything. The transferee company has to take everything. All assets and liabilities, add the book value. Understood? So the entry would be in accordance to that. See here, in entry would be, see here, all assets, all liabilities, book values, everything at book values. Yeah. Here in the purchase method, there is no such condition. जो कुछ transferee company लेना चाहती है वो लेगी. If they want to take certain asset, they will take. If they don't want to take certain assets, they will not take. It is up to the transferee company in purchase method. But in merger method, in the amalgamation nature of merger, what condition is there? सब कुछ लेना है. Everything you have to take. All assets, all liabilities, and at book values. So that is why the entry also would be like that only. Yeah, book values, all assets, all liabilities, and even reserves will also be taken. Whatever reserves will be there on the balance sheet of old company, those reserves, everything will be taken over at the book values. Simple, right? And then here what we used to do, if we are incurring loss, that means we are paying more purchase consideration than the net assets we are getting, then that used to be a loss, and we used to debit that to goodwill account. Yes, we used to debit goodwill account here, right? The balancing figure. But if we paid less, purchase consideration was less than the net assets, yeah, then we used to consider that as a gain or profit, and we used to take that to capital reserve. But here what we do is, if we get balancing figure on the debit side, yeah, then we will take it to loss on merger account, and if we pay less than what net assets we are getting, then we will take it to profit on merger account. These are temporary account that we will open, and then we will adjust these accounts to the free reserves of the company. Yeah, general reserve and what, profit and loss account. See here, it's very simple. So you understood this entry, all assets, all liabilities. Here it is not like that. Whatever asset the company has taken over, only those assets you have to take, and at agreed values, not at the book values in the purchase method. In the merger method, it is book values only. Understood? All liabilities, all reserves, all assets. Here, whatever that is taken over by the company, right? And business purchase will come as usual, because you have to cancel this account with an equal credit, right? Whatever that is debited over here, you have to credit that. Yes. And there is one more difference, right? The balancing figure difference. Here goodwill and capital reserve, here loss on merger or profit on merger, right? And then the third entry is, you have to adjust the loss on merger or profit on merger, whatever there is. Yes. So if there is a loss on merger, then you have to write off that loss. You have to cancel that loss. How do you cancel? Here it was debited, you have to credit that, and you will write off by utilizing your free reserves, general reserve and profit and loss. First priority you will give to general reserve. If the balance is not enough, then you will use profit and loss account, this reserve also. Yeah, and you will debit them, because you are using those reserves, you are reducing those reserves, and you want to reduce the reserve, then you need to debit them. Yes, this is how you will write off that loss, if there is any. Yeah, if there is profit, then you have to transfer that profit. Yeah, अगर कुछ profit है तो वो profit कहाँ जाएगा? Free reserves में, either to general reserve or to profit and loss. Okay, adjustment of loss or profit on merger. Yes, यही तो हम कर रहे हैं. Profit on merger account debit. Here the profit on merger was credited. Now we will debit that, and we will transfer the profit to general reserve or profit and loss account. Simple. Yes. And the fourth thing is, see here, the fourth entry is for payment of purchase consideration. Now here also there is a difference. Now you know the condition, right? The last condition which we saw. See here, purchase consideration should be paid only in equity shares to equity shareholders and preference shares to preference shareholders, isn't it? क्या देंगे purchase consideration? खाली equity shares और preference shares देना है, right? Only equity shares and preference shares देना है. तो उसका मतलब, see here, the entry would be, see here, liquidator of transfer company account. In the purchase method, we can give anything, equity share capital, yeah, and if the issue is at more than the face value, then that would go to premium, and then preference share capital, debentures, cash, anything we can give in the case of purchase method, there is no condition, nothing. But in the merger method, there is condition that only equity shares and only preference shares. Yes, equity shares to equity shareholder, preference shares to preference shareholder. इसका मतलब you can't pay debentures, you can't give debentures, you can't give cash. Yeah, but why I have taken cash over here? I will come to that. See here, the entry would be same only, the structure would be same only. We are paying to whom? To the liquidator. Yes, we will hand over the PC to first liquidator, right? So we are paying liquidator. So here his account was credited because liability was increasing, and we are paying the purchase consideration to liquidator. So we have to cancel that account by debiting it. Before it was credited, now it has to be debited to cancel that account. And then what all things you are going to give in the merger method, you can only give equity shares and preference shares. But in the calculation of number of shares to be given, what happens? Sometime we will get fractional shares, and we cannot give fraction shares. Okay, we can't give shares in fraction. That is why for the 25-30 rupees, what we are going to do is we are going to give cash. Okay, small amount of cash. That's the exception over here. You can't give full cash, only for fractional shares. Understood? So this is what, to equity share capital, to securities premium. If the issue is at more than the face value, then the extra money will go to securities premium and to preference share capital. Understood? This is the only difference. You can't take debentures and you can't take cash. You can't take cash, yeah? You can only take cash only for fractional shares. Fine. Okay. And then in the fifth entry, what do we do? Recording statutory reserves of transferor company. Yes, in the purchase method, since reserves are not taken over, there will be some statutory, some special reserve, yeah, which are created according to the law. Those have to be recorded in the new company as well. So that is why we pass this entry. But in the merger method, in the case of merger, everything is already taken over. सब कुछ पहले लेके हो गया है, सारे रिजर्व्स तूने पहले उठा लिया है, सारे के सारे तो नई कंपनी में रिकॉर्ड हो गए हैं, एवरीथिंग इज टेकन ओवर. तो क्या मतलब ये एंट्री का करने का, राइट? देयर इज no reason to make this entry, right? Because we have already taken over all the reserves, so you don't have to make this another entry, because सब कुछ इधर लेके हो गया, रिजर्व सब तूने पहले ही ले लिया है, फिर इधर लेना कुछ मतलब नहीं बनता है. Okay, are you getting my point? That's what, right? And then the sixth entry is issue of debentures. The same thing, yeah, the same entry which we passed here, the same entry you have to pass. Yeah, cancel the old debentures and issue the new debentures. How will you cancel the old debentures? By debiting them, and to create the new debentures, new liability, you have to credit that. And if it is more than the old debentures value, then it will be premium on debenture. If it is less, then it will be discount on issue of debentures. Yes. And then the seventh thing, see here the seventh entry, payment of liquidation or realization expenses by transferee company. Now here also there is a difference. In merger method, there is no mention of goodwill or capital reserve, right? So what do we do is, whatever expenses we are going to do, what we are going to do is we are going to take to the free reserves of the company, general reserve or P&L, whatever that is available with us. We are going to use the free reserves to pay to the transferee company expenses. Okay, so we'll utilize general reserve or P&L account, whatever that is there. Fine. To cash account. Understood? We are not going to use goodwill. So that is the thing, because here there is no goodwill, nothing. Yeah, here there is loss on merger and profit on merger, which are going to be adjusted in the what, which we are going to adjust in the free reserves. So here we are utilizing free reserves, so that is why free reserves will be used to pay off the expenses. Okay, so that's the seventh entry. And the eighth entry, in the eighth entry also there is no difference. As you can see over here, preliminary expenses, the expenses which we incur to form new company, yeah, whatever expenses that are incurred in incorporation of a company, those will be capitalized. Yes, preliminary expenses account debit to cash account, because we are paying cash, right? So cash account is credited. Simple. So this is the merger method. In merger method, the main difference is here only in the second entry, yeah, and we are going to use the free reserves if there is any balancing figure, right? We are going to use the general reserve or profit and loss. Yes, if it is a loss, then loss on merger. If it is a profit, profit on merger. But here we take goodwill loss, and here if there is a profit, we take it to capital reserve, and there is no adjustment here because it is already adjusted in goodwill and capital reserve. But here these are temporary accounts, profit on merger or loss on merger. We have to adjust those accounts, we have to close those accounts and transfer the whatever amount is there, here we have to write off and here we have to transfer the profit. Understood? So that is why we do these two entries. Yeah, not two, any one of them you have to do, right? If it is loss, write off the loss. If there is profit, transfer the profit. And then in the purchase consideration also there is a difference, that you can only give equity shares to equity shareholder, preference shares to preference shareholders, yes, and then cash only for fractional shares. But here you can give anything, bonds, debentures, preference share capital, equity shares, cash, whatever. And you don't pass this statutory reserve entry also in the merger method because everything is already taken over here. Yes. And then one more difference is the payment of liquidation or realization expenses, where we will use the free reserves, right, general reserve or P&L account, to pay off the realization or liquidation expenses. Fine. So these were the journal entries in the books of Transferee Company. Now in the next video we are going to solve problems. Okay, see you in the next video.